Hello, this is Raymond Shapiro, and I'm the Portfolio Manager of the Merchant West SCI Dividend Equity Fund. This is the fund review for the period ending 31st March 2024. The fund produced a resilient performance over the quarter, gaining 2.4%, outperforming its benchmark, the South African General Equity Peer Group average, which lost 1.6% for the period. The JSE Cap Swix Index fell 2.3% over the quarter, and the JSE All Share Index lost 2.2% over the period. The fund's return over the period was strongly driven by its direct offshore exposure, 44% of the fund, which rose 10% in rands and 6.3% in US dollars, and to a lesser extent by select SA non-resource rand hedge holdings, which rose 3.9% as a group. A weak SA economy and jitters around upcoming elections sapped confidence locally, the result being that the fund's SA economy-centric or SA Inc. equities dragged on performance, falling 4% over the quarter. However, SA property holdings gained 2.4% over the period. Our position in SA long-dated government bonds lost 2% over the quarter. Stock-specific contributors over the period included Novo Nordisk, multinational software company SAP SE, and British American Tobacco. Detractors included FirstRand and Standard Bank. While the global narrative for economic growth has shifted from a talk of so-called hard landing to soft landing to no landing, recession indicators have not dissipated. These include inverted yield curves, tight credit conditions, and disrupted trade flows. In addition, the world is facing increased uncertainty due to geopolitical tensions, conflicts in Ukraine and the Middle East, and potential political changes across the globe, with more than half the world, including the US and the UK, facing national elections in 2024. On the upside, rate cuts are still expected throughout 2024 and 2025 on the back of forecast cooling inflation. Given the fragile and uncertain outlook globally, our approach is to focus on investing in robust, high-quality businesses with conservative balance sheets. Quality defensive stocks that are able to weather tougher economic conditions should serve investors well in 2024. Stable dividend-paying stocks, backed by reliable and defensive cash flows, are likely to prove especially effective. Despite the depressed situation in South Africa, SA economy-centric or SA Inc. equities appear to be pricing in the current tough conditions and are trading at an estimated lowly forward PE ratio of 9 times and a 5.9% forward dividend yield. The forward dividend yield of the fund's SA Inc. equities, we estimate, is 6.8%, well in excess of the 4.9% estimated forward yield of the JSE All Share Index. These are very attractive levels relative to their own history, other markets, and in absolute terms. In addition, forecast earnings and dividend growth rates for SA Inc. equities are expected to be in the mid to high single digits over the next 3 years, comfortably beating inflation. The relative attractiveness of SA dividend-paying companies, we believe, is still highly underappreciated by investors. Nonetheless, we are still cautious about the risks attached to the local economy, especially as regards to the state of the consumer, load shedding, and the political situation, including the upcoming election. Additionally, weak global and China growth prospects will undoubtedly flow through to the resource-driven SA economy and further weaken the already fragile SA fiscal situation. Metal prices are vulnerable to global growth slowdowns, and as such, we maintain a significant underweight to resource stocks. Importantly, we believe owning significant weights in both resource counters and SA Inc. equities to be poor risk management in the current environment. Instead, in addition to owning SA Inc. equities, we favor a position in defensively skewed and robust global dividend equities, which currently comprise 44% of the fund, as well as holding select non-resource rand hedge stocks, making up 10% of the fund currently.